Hi, and welcome to this short presentation on the exposure draft PBE IPSAS 43 leases. This is relevant for Tier 1 and 2 public benefit entities in New Zealand. I'm Karis, Technical Director of Accounting Standards, and I'm joined by Gali, Senior Project Manager, and we're in the accounting team at the External Reporting Board. We've both been involved in this consultation and exposure draft, but Gali to a much deeper extent than me. So I'm going to interview her today so that you can benefit from her insights about the proposals and the questions that we're seeking your feedback on. We'll start by considering why we're proposing a new standard. Currently, lessees distinguish between finance and operating leases. This distinction is going to go away for lessees, with most leases coming on balance sheet. We think that this change in the proposals as a whole will have a number of benefits for New Zealand PBEs and the users of their financial statements. One of the benefits I see is international alignment. PBE IPSAS 43 is based on IPSAS 43, and this in turn is aligned with NZ IFRS 16 and IFRS 16 in the for-profit space. So this means that under the proposed standard, New Zealand PBEs will be able to benefit from the latest international thinking on lease accounting. A related benefit to this is that it makes for easier reporting for mixed groups in New Zealand. So these are PBEs with for-profit subsidiaries, like a council-controlled organisation. Another key benefit I see from bringing most leases on balance sheet is the increased comparability between PBEs that lease assets and those that buy them. So this means that PBEs with mainly operating leases at the moment will be more comparable with PBEs that mainly purchase or currently have finance leases. Gali, what are the other key benefits that you see for the proposed new standard?
I think another key benefit relates to the increased transparency around leases and the lessee's financial statements. So if we think about a lease, the lessee has an obligation to make lease payments as per the lease agreement, and the lessee also has a right of use asset for a right to use the asset for an agreed period of time. But under the current requirements, if the lease is classified as an operating lease, this obligation that I mentioned and the right to use the leased asset are not reflected on the lessee's balance sheet. Bringing the leases that are currently classified as operating leases onto the balance sheet would mean that when a user of the financial statements of a PBE lessee looks at those financial statements, they will be able to get a more complete picture of the PBE's obligations and of the resources available to the PBE to deliver its services. Another benefit of the proposals is that with most leases being brought onto the balance sheet, users of financial statements would not need to use a variety of different techniques and take into account various levels of detail provided in note disclosures when they want to know the impact of leases on the lessee's balance sheet. So the proposals would make for a more level playing field for users of financial statements when they compare the financial performance and position of different PBEs.
So we've published an exposure draft, sometimes referred to as an ED, and a consultation document. What are these documents about, Gali?
So the exposure draft, that's essentially the draft of the proposed new standard PBE IPSAS 43 leases. This proposed new standard is based on IPSAS 43, which was issued by the International Public Sector Accounting Standards Board, or IPSASB, earlier this year, and it is aligned with the for-profit standard IFRS 16 leases. As we mentioned before, the proposed standard would require lessees to bring most leases onto their balance sheets, but lessor accounting would remain substantially unchanged. We also published a consultation document that accompanies the exposure draft. The consultation document summarizes the proposals in the exposure draft and includes questions that we're keen to hear your views on.
So now we're going to give you a quick overview of the key proposals in the exposure draft and the questions that we want your feedback on. As the name suggests, the proposed new standard includes requirements for the accounting for leases. So it's really important to first make sure that we're all on the same page in terms of what leases are. Can you help us with this, Gali?
Sure. So firstly, a lease has to involve an identified asset, like a specific car or a specific building that the lessee has the right to use. Secondly, there needs to be a contract that conveys to the lessee the right to use the identified asset, which I'll come back to in a moment, for a specified period of time, such as, say, 5 years, in exchange for consideration, like, say, a monthly rental fee. For the right to control the use of the identified asset to exist, you need to have the right to obtain substantially all the economic benefits or service potential of the leased asset over the lease term. And you also need the right to direct the use of the leased asset over the lease term. There are requirements and guidance in the proposed standard to help you determine whether you have these rights.
Thanks for that background. So we're now going to move on to the proposed requirements for leases, focusing on lessees. So as we said before, the proposed standard requires lessees to bring most leases onto their balance sheet. Gali, can you run us through what this means? How would a lessee go about recognising a lease on their balance sheet?
Sure. So under the proposed standard, the general requirement for lessees is to recognise on the balance sheet a right of use asset representing the right to use the underlying asset that's being leased for a period of time, and the lease liability, which represents the obligation to make future lease payments. There is an exemption from this requirement for some types of leases, which we'll talk about soon, but for most leases, there would be a right of use asset and a lease liability on the lessee's balance sheet. On initial recognition, so in other words, when you first recognize the lease in the financial statements, the lease liability is based on the future lease payments as per the lease contract, and these payments are discounted to present value as explained in the proposed standard. This is also the starting point for measuring the right of use asset on initial recognition.
And what happens after the right of use asset and the lease liability are recognised? Do they stay on the balance sheet for the lease term?
That is definitely useful to explain. So after the lease is first recognized on the balance sheet, in general, the right of use asset gets depreciated over the lease term, usually on a straight line basis. So your right of use asset decreases over time, and you have a depreciation expense in your surplus or deficit. This is known as the cost model for the right of use asset. In some circumstances, other models are available. In terms of the lease liability, I mentioned before that when the lessee first recognizes a lease in the financial statements, the lease liability is measured based on the future lease payments discounted to present value. After initial recognition, the discount unwinds, which results in interest accruing onto the lease liability, and the payments made by the lessee reduce the lease liability. So it's a bit similar to a mortgage in this way. The interest on the lease liability is accounted for in surplus or deficit as a finance cost. At the end of the lease term, both the right of use asset and the lease liability will have reduced to nil.
Thanks for that summary. The overall impact of the proposed standard on a lessee's surplus or deficit would depend on a lot of factors, like the age of the leases across your lease portfolio, the transition method that you choose when transitioning from the old requirements to the new ones. What we have on the slide here, and you can see in the orange boxes with the arrows, is a simplified overview of the effect that the proposed right of use model would have on the lessee's financial statements. So Gali, do lessees have to apply this right of use model to all of their leases?
Thanks for that question, Karis. This is a good time to mention the exemption from the right of use model in the proposed standard. This exemption applies to short-term leases and to leases of low-value assets. For these types of leases, the lessee doesn't need to recognize a right of use asset and a lease liability on the balance sheet. Instead, the lessee can choose to treat the lease payments as an expense over the lease term, similarly to what they currently do for operating leases. If you're wondering what is a short-term lease, that would be a lease where the lease term, as defined in the proposed standard, is 12 months or less.
What if the lease agreement says that the lease is for 12 months, but the lessee has a right to extend the lease?
That's a very good point. So when determining whether a lease is a short-term lease for the purpose of the exemption, a lessee would need to take into account not just the original lease term, but also the right to extend the lease if the lessee is reasonably certain to exercise this right.
And what about the leases of low value items?
A lessee can also apply the exemption from the right of use model to leases where the leased asset is of low value when it's new.
How does a lessee go about assessing if the underlying leased asset is of low value? If I'm leasing 100 laptops, do I need to add them all together and see if the value is low to me?
This is a good question. So the assessment of low value in our proposed standard is aligned with the requirements in the IPSASB's IPSAS 43. Our understanding of these requirements is that the assessment of whether a leased asset is of low value is done on an individual asset basis. In other words, you would not need to add up 100 laptops. Rather, you would consider whether a laptop individually is a low value underlying asset. I should also mention that the assessment of whether the leased asset is of low value is done on an absolute basis. So this means that the lessee's size, nature, or circumstances don't matter for this low value assessment. The idea here is that different lessees, whether it's a large organization or a small one, would come to a similar conclusion as to whether an underlying leased asset is of low value. And this is consistent with IPSAS 43.
Is there a monetary threshold in the proposed standard or examples for people to look at?
So the IPSASB decided not to specify a monetary threshold for low value, and our proposals also don't include a monetary threshold. But there are examples in the proposed standard as to what assets would generally be considered low value. These examples include phones, tablets and personal computers, and small items of office furniture, but not cars. Hopefully, these examples should help PBEs with determining whether a leased asset is of low value for the purpose of applying the exemption from the right of use model.
In the proposed standard, there's a scope clarification for concessionary leases. Gali, do you want to explain why there's that scope clarification?
Yes, this is a good point to look at for sure. So past consultations in New Zealand on earlier IPSASB proposals on leases indicated that there is a general agreement with aligning lease accounting requirements for PBEs with IFRS 16, but we did hear concerns about the possibility of having to account for concessionary leases at fair value. IPSAS 43 does not include fair value measurement requirements for concessionary leases in that standard. But given the concerns that we heard in New Zealand, we added into our proposed standard an extra clarification that concessionary leases do not need to be measured at fair value. So we have clarified that concessionary leases that meet the definition of a lease are in the scope of the proposed standard, but when applying the requirements of the proposed standard, a PBE would take into account the lease payments as per the lease agreement, rather than what payments would have been charged had the lease been at market terms. I should also mention that the IPSASB has a separate project considering how to account for the concessionary portion of concessionary leases, and also how to account for arrangements that are similar to leases, but don't quite meet the definition of a lease. We expect the IPSASB to start an international consultation on this topic next year, and once they finalize this project, we will consider whether we should propose changes to the scope clarifications I just mentioned.
So let's go now to the consultation questions. So these are the specific questions in the consultation document that we'd like to hear your feedback on. So the first question is, do you agree with the proposed scope clarification with respect to concessionary leases that Gali's just taken us through? The second question is about low value assets and whether that should be performed on an absolute value basis for each individual leased asset as proposed in the exposure draft and as aligned with IPSAS 43, as Gali explained previously. The third question is, do you agree with the proposed reduced disclosure regime concessions? So these are the disclosure concessions for Tier 2 PBEs You can read these in the consultation document where they are summarised, or you can see them in full in the exposure draft. And these are aligned with NZ IFRS 16 in the for-profit space. Then moving on to our fourth consultation question, which is to do with the effective date of the proposed standard. We propose that it will become effective for annual periods beginning on or after 1st of Jan 2027, which does seem like a long way away. Gali, can you explain why we've proposed this long effective date?
The reason we suggested 1 January 2027 as the effective date is because, firstly, we wanted to make sure that PBEs have enough time to prepare for implementing the proposed new standard. Secondly, we didn't want PBE IPSAS 43 to become mandatory before any possible requirements related to concessionary leases and other lease type arrangements are also available. Also, if a PBE wants to adopt the proposed PBE IPSAS 43 early, once we have finalized and issued it, they will be able to do so. We propose to make early application available.
So with that context in mind, do you agree with the proposed effective date of 1st of Jan 2027 with early adoption permitted? So this brings us to our fifth and final consultation question, which is, do you have any other comments on the exposure draft? You can send us your comments through our consultation page, which is shown on the slide, or by emailing accounting@xrb.govt.nz, and you need to get your comments into us by the 25th of November. We consider all feedback received, and then we work through that to finalise the standard after the consultation period. Thanks for watching this presentation. We hope it was useful. If you'd like to receive reminders about commenting on this consultation, please feel free to subscribe to our newsletters or follow us on LinkedIn. Thank you.